Welcome to Thoughts on Investing. Okay, so the AI boom is definitely here, and you can see it everywhere, especially in stock prices. Every company out there is scrambling to be part of the race. But how do you, as an investor, find the real growth stories without just, paying way too much for the hype? Well, in this explainer, we're going to look at a really powerful but surprisingly simple tool to help you find potential AI growth at a price that actually makes sense.
All right, before we dive in, I gotta do the serious part. Just a quick reminder, this is for educational purposes only. It is not financial advice. Investing has risks, you could lose money, so please, always do your own research before making any decisions.
So, this is the big question, isn't it? How do you get ahead of the curve? How do you find that next major AI stock before the rest of the world catches on? The real challenge is spotting a company that's ready for explosive growth before all that potential is already reflected in its stock price. Honestly, it can feel like you're searching for a needle in a haystack. But thankfully, there are tools that can help guide you.
And that's where a really savvy strategy comes into play, one that smart investors have used for years. It's called Growth at a Reasonable Price, or GARP for short. Think of it as this perfect middle ground. You're not just hunting for deep bargains, and you're not just chasing those super high-flying growth stocks. And the key tool for any GARP investor is one simple but incredibly powerful metric.
It's called the PEG ratio, and I promise the idea is way simpler than it sounds. It takes the PE ratio, which we all know. It basically tells us how expensive a stock is today, and it compares that to the company's expected earnings growth. Here's an analogy. Think of it like a race. The PE ratio is how fast a runner is going right now, but the PEG ratio, that tells you how quickly they're accelerated.
And this is exactly where it gets interesting. A low PEG ratio might mean you found a company that's picking up speed, that's growing its earnings faster than the market is giving it credit for. It's a potential sign that the stock's price just hasn't caught up to its future growth yet, and that gives you a reason to take a much closer look.
For GARP investors, the magic number is typically anything below 1. When you find a company with a PEG under 1.0, it's kind of like a green flag. It suggests that its expected growth rate is actually higher than its current PE multiple. It's a clear signal to start digging in and asking some more questions. Okay, so let's put this tool to the test. We've pulled together a watch list of some of the biggest names in tech and AI that right now have a PEG ratio under 1. Now, please remember, these numbers are a moving target. They change with stock prices and analyst forecasts every single day. So think of this as a starting point, a place to begin your own research.
First up, let's look at the chip titans. These are the companies literally building the foundation for the entire AI revolution. You've got the leader, NVIDIA, its biggest challenger, AMD, Broadcom, which is absolutely crucial for networking and custom chips, and of course, Taiwan Semi, the company that manufactures pretty much all of these chips for everyone. What's so interesting is that even though they're massive, their PEG ratios all suggest their growth story might not be fully priced in just yet. Now, check this out when you put the two main rivals side by side. NVIDIA, the undisputed leader, still has a PEG that's well below 1. But look at AMD. Its PEG ratio is even lower. Now, what that suggests is that if, and that's a big if AMD can hit its really ambitious growth targets with its new AI chips, then the stock could be very reasonably priced right now. It's a classic risk versus reward situation. Okay, but it's not just about the big iron in a data center. Let's look at software and what's called Edge AI. You've got enterprise giants like Salesforce embedding AI everywhere, creative powerhouses like Adobe with its amazing Firefly tools, and ad platforms like Pinterest using AI to get you to click. Then you have companies like Qualcomm putting AI right on our phones, and DocuSign automating all those business processes. All of them, right now, have PEG ratios that make you want to take a closer look.
So this all sounds really promising, but okay, hold on. We have to do a reality check. It's so important to understand the limits here. No single number can ever tell you the whole story, and the PEG ratio has a pretty big blind spot. You see, it's only as good as the G in PEG, the growth estimate, and that, my friends, can be a very, very big if.
And this is probably the most important thing to remember from this whole explainer. A low PEG does not automatically mean a stock is a bargain. Sometimes it's actually a warning sign. It could mean the market is skeptical. Maybe there's intense competition, or maybe there are broader economic problems. Or maybe, just maybe, the company has a track record of overpromising and under-delivering. The low PEG is the market telling you it doesn't quite believe the forecast.
So after all that, what's the big takeaway? How can you actually use this metric effectively when you're looking at this incredibly crowded and hyped up AI landscape?
Here's the best way to think about it. The PEG ratio is not a crystal ball.
It will not predict the future. Think of it more like a flashlight. It doesn't tell you what to buy, but it shines a light on parts of the market that deserve a closer look. It helps you spot companies whose growth might just be misunderstood or underestimated by everyone else. Use it to find where to start digging.
So there you have it, a simple tool to help you cut through some of that AI hype. If this explainer helped you out, a like and a subscribe would be absolutely fantastic. Thanks so much for watching.